Hello guys, welcome back to the channel. In today's video, I'm going to be doing a more educational one on what equities are and why basically I invest in equities or stocks. So for those of you that don't know me, I'm Jack. I'm an investment analyst at a wealth management company. I've got a degree in finance and I'm a CFA, I'm waiting my CFA level 3 results, which are effectively a financial exam, professional exam series. So, I feel fairly well qualified to talk about equities. I know what sort of the pitfalls or struggles are when it comes to clients and end investors understanding how equities work. So in this video, we're going to break down basically what a stock is, how they entitle you to certain payments, certain returns, and what you can expect from them as an investor. If you see the rest of my channel, it's all about what equities I'm investing in, how I invest in those equities, why I've invested in them. So hopefully this video, if you're new to finance, should help you understand how stocks work. Before we dive in, I do want to remind everyone that this is not financial advice. This video is for education and entertainment purposes only. But yeah, with that said, we'll dive into basically what an equity is. So an equity or a stock is basically a share in a company. That's why they're called shares. So if you go to a stock exchange and you part with your money for, let's say, a Google share, you become a part owner in Google. So what that means is any earnings, any profits they make, you become entitled to a share of. And all of their assets, effectively, you own a part of them, but you own Google's assets at that point. And that's where we get into the return drivers. So as an equity holder, you have what's called a residual claim on the assets, which means you have to wait until the debt holders have been paid. You have to wait until the government has been paid, so taxes, and whatever's left over is what you receive. And that's why your return depends on the success of a company far more than a bondholder does, because they get paid before the profits. So think about it this way: a loss-making company can still pay their interest payments to the debt holders, but they can't pay the equity holders any dividends, or they can't buy back any shares. So your performance is directly tied to the performance of the company's earnings for the most part. There are outliers, but for the most part. And that is why they are more risky. That is why they are more volatile. So in times of a recession where corporate profits can dive 30, 40, 50%, depending on where you're invested, equity holders will be hit very hard. And at the same time, when we go into an economic boom, equities are where you want to be, because the economy is improving, companies are making more profits, which means they can deliver that profits to shareholders in the form of either dividends or capital gain. So capital gain is where stock price is going up because the value of that business is going up, and therefore the share of that value increases. And dividends is basically a cash payment, and typically you'll see those from large companies that don't have many sort of growth opportunities. So think of like a Tesco, for example. They do produce new stores, they do make new stores and stuff like that, but for the most part, they're established in every town that they want to be established in. They raise their prices broadly in line with inflation, that sort of thing. So they pay quite a decent dividend. I think it's 4 or 5%, and that's how they really return money to shareholders. And if you compare that to something like Nvidia, or I think Google pays a small dividend now, but Nvidia or Google, they've got tons of growth opportunities in AI. So whether it's building factories or data centers, they don't want to pay out the money as a dividend because they want to keep it, invest it in high return opportunities, and then in 5 or 10 years, now the capital gain component has increased dramatically and the shareholders are better off, just in a different way. So in terms of long-term performance and long-term returns, it makes sense that equities are generally the best asset class, and that's because the economy has only really grown over time. Individuals have an incentive to make themselves as rich as possible in a capitalistic environment. They create businesses that are innovative and can generate returns and can grow their profits, and the bad businesses go out of business. The good businesses continue to grow and earn more and more and more money. So when you think about stocks at an index level, say the S&P 500, you've got the good companies always flowing in and growing, and eventually when they become poor businesses, which almost always happens, they then leave the index, and now you're left with an index of winners. And that brings us on to active versus passive equity investing. So an investor like you or like me can go onto a investment platform and buy an index. Let's take the S&P 500 again as an example. That is the 500 largest companies in the US that I think are profitable for a certain period of time. There's a certain rule to get in. But effectively, as I just said, because the losers go out of business and the winners continue to innovate and grow more, what you're left with in equities is an index of winners at the index level. And that is why Warren Buffett, for example, is a big advocate of passive investing, and that's why passive investing has grown so much in recent years, is because it tends to outperform active, given that nature of being only in winners. Active is the alternative, where you basically pay a fund manager a little bit extra to pick stocks that they think are undervalued and go underweight stocks that they think are overvalued. Or they could do specific strategies. So for example, in my ISA portfolio series, you'll see Polar Capital Global Insurance in there, which is a specialist fund that invests only in insurance companies. And there isn't really an index that you can invest in that performs that theme or that investment exposure. So that's where active comes in. That's why I use active more than anything. It's not really to beat a general market index, it's just to get specific exposure where I want it. But both have their place. It's just a case of what you prefer. And for the vast majority of investors, even potentially myself, although I like to be active, passive is better because it prevents you from trying to time the market or be silly, basically, which most investors are, especially in the retail space. Finally, wanted to touch on the risks to equity investing. So the first one, like I said, is the economic shock side, the volatility side. You have to be prepared to stomach things like recessions or things like COVID, where equity markets can sell off 30%. Even recently with Trump's tariffs, even though the economy hasn't yet turned in any real sense, you saw equity markets off 20% in basically 2 or 3 weeks. And that's something you have to be prepared for, not just to stomach the paper loss, but also that can really play with your emotions. And if you're not yet experienced in markets, stuff like that can cause you to sell out. And if you sell out at the wrong time and then have to buy back in, it can cost you a lot of returns and a lot of money, which is why it's not just the pure volatility aspect, it's also the psychological impact of that volatility and how you think you'll react to that. And then the other two things I've got written down here are regulatory and political risks. So again, going back to Trump, let's say tomorrow he decides that he hates, what does Trump hate? Let's say he hates social media. I don't know, let's just say he hates social media. So because he owns Truth, he might say, well, I've had enough of Facebook. I'm going to put, I don't know, 100% tax on Facebook. Let's just say he did that with it's an emergency power. Suddenly your Facebook shares are worth a lot less. So it's that. I mean, it's less of a problem in developed markets, or at least it was. It's a big problem not a big problem, but something to be more aware of in emerging markets. So that's that. That is a very brief overview of how equities work and their role in a portfolio. I can go into a lot more detail on this, and I'm thinking about doing a follow-up video depending on how this one performs. But yeah, let me know in the comments if you enjoyed it. Please leave a like and subscribe, and I'll see you in the next video.